Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Mastering Arbitrage Pricing Theory, Unlocking Market Secrets. Applications of Arbitrage Pricing Theory. Arbitrage Pricing Theory, APT, isn't just an abstract financial model. It's a practical tool used every day in investment strategies. By linking asset prices to multiple risk factors, APT provides insights that help investors manage portfolios and risks with more precision. In this section, we'll explore how APT shapes portfolio management and supports risk management strategies. Portfolio management and APT. APT serves as a guide for building diversified portfolios with an emphasis on efficiency and balance. Instead of relying on one factor, like market risk in CAPM, APT accounts for multiple influences, allowing investors to construct portfolios tailored to their goals and risk tolerance. Here's how. Factor sensitivity analysis. APT analyzes how sensitive different assets are to economic factors like inflation, GDP growth, or interest rates. With this analysis, an investor can choose assets that align with their expectations of these variables. Customized portfolio. Weighting. By understanding the influence each factor has on expected returns, portfolio managers can assign weights to assets based on factor exposure. For example, if GDP growth is expected to rise, they may favor assets highly sensitive to economic expansion. Reduction of non-systematic risks. While APT emphasizes systematic risks, it also helps to identify unsystematic risks in individual assets. Diversification under APT ensures idiosyncratic risks are minimized, leading to a more stable portfolio performance. APT also offers flexibility. Investors can adjust their portfolios as market conditions change, adapting quickly to new risks or opportunities. Think of it like steering a car. APT gives you multiple gauges to check before you decide whether to speed up or hit the brakes. Risk management strategies using APT. Every investment is tied to risk, but APT equips investors with a framework to identify and manage those risks effectively. By splitting risks into factors, APT provides clarity over where potential vulnerabilities lie. Here's how APT enhances risk management. Identifying risks with precision. APT breaks down risks into measurable factors. If rising interest rates are a concern, investors can pinpoint assets most affected and adjust their holdings accordingly. Predictive risk assessment. By assigning sensitivities, betas, to different factors, APT enables investors to predict how assets may respond to changing economic conditions. This foresight is essential for proactive risk management. Hedging opportunities. APT helps identify where to hedge. If inflation risk looms, investors can add inflation-linked securities or reduce exposure to assets vulnerable to price level shifts. Stress testing scenarios. Portfolio managers often simulate various economic scenarios using APT to see how their investments might perform. This exercise exposes weaknesses, helping them act before losses occur. In practice, APT is especially useful for institutional investors managing large, complex portfolios. It's like having a weather forecast tailored to specific economic conditions. APT helps you prepare for storms or clear skies ahead. By isolating risks and analyzing their drivers, APT transforms risk from an abstract concept into something measurable and manageable. It's no surprise that this model has become a go-to tool for investors aiming to protect their portfolios while capitalizing on strategic opportunities. Advantages and limitations of APT. Arbitrage Pricing Theory, APT, has earned its place in finance for its unique approach to asset pricing. Unlike traditional models, APT breaks down returns into multiple risk factors, offering flexibility and depth. However, like any theory, it has strengths and weaknesses. This section outlines both sides to give you a clear understanding of APT's role in financial analysis. Advantages of using APT. APT offers several distinct advantages that make it attractive for investors and analysts. Here's why it stands out. Flexibility in risk assessment. APT doesn't rely on a single market index like CAPM. Instead, it allows users to include various economic factors that matter most to their analysis. For example, an investor concerned about inflation and GDP growth can integrate those as primary variables. Incorporation of multiple factors. Think of APT as building blocks. Each factor represents a piece of the puzzle, and together they form a detailed picture of risks and returns. By accounting for inflation, interest rates, and even sector-specific trends, APT provides a broader and more accurate pricing model. No dependency on market efficiency. Unlike some other theories in finance, APT doesn't require markets to be perfectly efficient. This makes it practical for real-world applications where inefficiencies often exist. Customizable applications. Financial markets are ever-changing, and APT adapts easily. Analysts can update their models to include new factors based on current events or emerging trends. This makes it highly relevant in dynamic environments. Deeper insight into risk sensitivity. APT shines in its ability to measure how specific assets respond to different risks. For instance, tech stocks might have high sensitivity to interest rates, while energy stocks feel the impact of oil price fluctuations. By using APT, investors gain a more tailored approach to pricing and risk assessment, which is harder to achieve with one-dimensional models. Limitations and critiques of APT. While APT has its strengths, it's not immune to criticism. Let's break down the notable limitations. Identifying relevant factors is complex. APT doesn't specify which factors to use, leaving this to the discretion of the analyst. While this offers flexibility, it also creates challenges. How do you decide which risks truly matter? If you pick irrelevant factors or miss important ones, your model becomes flawed. Limited practical implementation. In theory, identifying and measuring multiple factors sounds great. In practice, it's tough. Some factors, like geopolitical risks, are hard to quantify, and historical data isn't always reliable for prediction. Assumes no arbitrage perfectly. APT's foundation rests on the assumption that arbitrage opportunities don't last long. While this is generally true in efficient markets, occasional mispricings and inefficiencies can persist, especially in volatile periods. Overemphasis on linear relationships. APT assumes that the relationship between factors and returns is linear. Real-world scenarios, however, are often more complex with non-linear interactions. For instance, inflation might affect stock prices differently at varying thresholds. Data-intensive. Building an APT model requires robust data across numerous variables. For smaller investors or firms without extensive resources, this can be a barrier. Comparison to CAPM. While APT is more flexible than CAPM, it lacks the simplicity of a single-factor model. Many investors favor CAPM precisely because it's easier to apply, even if it's less nuanced. In many respects, APT is like a Swiss Army knife. It provides tools for detailed analysis, but using them effectively requires expertise, time, and resources. Without those, its potential benefits are harder to realize. Both its strengths and critiques highlight one key takeaway. APT is a powerful model, but it's not a universal solution for every pricing problem. For those willing to invest the effort, it offers value beyond what simpler models can achieve. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.